Hello, good morning and welcome everyone. Thank you for joining us on True Potential's Morning Markets. In today's video, we'd like to cover the release of the UK employment data. Before we get into the UK unemployment data, we'd like to discuss the geopolitical tensions that we are seeing and how markets have reacted at open this morning. So the main two areas to focus on are within equities and within commodities. So within equities, at European open, we can see that equity markets have opened weaker, and we've also seen a similar trend within Asian markets overnight. So they've closed lower than where they opened this morning. Within commodity markets, the main place that we're seeing that play through is within oil and energy prices, which have moved higher following those geopolitical tensions. So if we move over and focus upon the UK employment data that was released this morning, what we have saw is that the unemployment rate within the UK has moved higher by 0.2% up to 4.2%. So that's up from 4 to 4.2%. What we think is important, though, is to provide context around that and look at previous periods to see whether the labour market is still tight or whether it's slack. So if we look at the range between 2010 through to 2019, we see that average rate is at 6.1%. So although the rate has moved slightly higher, it's still tighter than that period's average. And really what we believe that to be is a slight rebalance of the labour market following the extreme tight levels that we have saw following the economy's reopening after the COVID-19 pandemic. The other bit of information that is released alongside of this is wage data, and what we have saw is that's remained quite sticky. So it had been 6.1% and the market had been expecting it to fall. Well, it did fall, it fell to 6%, but that was still higher than what markets had been expecting. So the impact of this is the theme that we have spoken about of real wage growth within the UK that remains. So with wages remaining sticky and the rate of inflation falling, it means that real wages within the UK continue to grow. That means that should be a positive for UK GDP growth, although the downside of this is that it's one of the key components that the Bank of England is monitoring wage growth. So with wages remaining sticky, that's likely to mean the Bank of England are less likely to reduce interest rates in some of their upcoming meetings. So thank you for watching today's video, and we'll catch you on tomorrow's episode.